All right, what is going on, everybody? My name is Arman Vakili, and this is the Stock Splits Show, the show where we talk about stocks that split. So, just in case you did not know, a stock split is when a company divides their existing shares into multiple new shares. And they do this to boost liquidity, to gain more investors, market cap, etc. Although the number of shares increases by a multiple, and I'll explain what that means, the actual value of the shares stays the same, so does the value of the person's portfolio, right? So if it's a 2-for-1 or a 3-for-1, sometimes it's 100 to 105 or something like that, or it can be some of these like weird ratios sometimes, but typically it's about 2-for-1, 3-for-1, maybe 4-for-1 sometimes. And what that looks like is if you start with 2,000 shares and they're at $300 a share, after the split, if it's a 3-for-1 share, or a 3-for-1 split, excuse me, your 2,000, each one of them will split into 3, so you'll have 6,000 shares, but the actual value drops to 100, right? So your overall portfolio value, stays the same. So 2,000 times 300 is the same as 6,000 times 100. So why would somebody do this? Why would a company do this? We talked about liquidity a little bit. We talked about market cap a little bit. But there's also press that comes with doing something like this, that they'll actually get announcements to the stock exchange or to the market in general where people are aware of it. And then they, hey, you know what? This was before the era of digital investing, right? Before you can just put $50 into Amazon through an app or something, you actually had to purchase the full share. You had to actually go buy a share in, let's say, Disney, right? So before that it took place, it was something that people couldn't really buy, $300 shares or something like that. So every time this happened, more investors came in and they're like, okay, well now I can afford it and I'll go buy a share, or I'll buy a couple of shares because the price has dropped. So the overall value of the company ends up actually growing. The market cap ends up growing because even more investors who can afford end up coming in and investing within the company. So the case study that we're talking about today is a company called Procter Gamble. Now, I don't know if you recognize these guys or if you've heard of them before, but I'll go into a list of the companies that they own and a list of the brands that they own, and then you'll for sure recognize them. But Procter Gamble has split historically 6 times so far. The first one is 1970, that was a 2-for-1 split. Then in 83, another one. 89, another one. 92, another one. 97, and 2004, and those are supposed to actually be 2-to-1 as well. So 97 and 2004 were also 2-to-1 splits. So across the board, it was all 2-to-1 splits with Procter Gamble. Okay. So we're going to look at the brands that they own, and then we're going to look at what these splits actually did to them historically, to their market value and the share price, right? So first, let's see what these guys actually own. So it's kind of small, so I don't know if you can see this right here, but I'll read it for you. So we have Always hygiene products. We have Ariel laundry detergent, Bounty. I've heard of Bounty. I'm sure you've heard of Bounty as well. The quilted quicker picker upper, Bounty. Charmin, which was toilet paper. Crest toothpaste, Dawn dishwashing soap, Downy fabric softener. Fairy, which is a shopping liquid. I haven't heard of that one. Febreze, you've heard of Febreze. You've heard of Gain, which is another laundry detergent. Gillette, shaving soap, razors, cream, body wash, all that stuff. Gillette is huge. Head and Shoulder shampoo, huge. Olay, oil of Olay, personal beauty products. Oral-B, Pampers, Pantene. These are really big. Tide, are you kidding me? They own Tide. Like, these are really big brands. Vicks, Vapor Rub, and cold medication. So these are gigantic brands. So I'm sure you've heard of at least one of these brands right here, okay? So this is Procter & Gamble. This is what they actually own, and this is literally net sales right here, more than $1 billion annually across these brands that they have. Okay, so pretty big company. So now let's look at their stock performance, right? So first split was in 1970. Unfortunately, we can't go prior to 81. So the next one after that was 83. So at 81, the stock share, its value is $2.21, which is actually higher than a lot of the ones that we've looked at so far in this series. So 221 is 1981, the value. The 80, so we're going to compare from March of 81, and we're just going to keep going that way. So March of 83, if we go look at it right here, and where is it? 82, 83. So March of 83 is 362. So it is an increase, but not anything crazy, right? Next one was in 89. So if we go to March of 89, we have 563. So again, increase in value compared to the previous companies that we looked at. If you go look at those episodes, the lines that they have, the actual historical value of their stocks, in a lot of cases, it's like almost a flat line. So this is the first company that we've looked at that they've steadily been increasing with every single split that we've looked at, okay? So 89 was this one. And then the next one is 92. So if we go to 92 March, again, $12.30. Again, an increase in value. 97, March of 97, 31.05. And then 2004, you have the last split. And March of 2004, it was 52. So even compared to 97, even after the crash that happened in 2001, with the Y2K 2001, and then there was obviously the war that happened between the States and the 9/11 Twin Tower and all that stuff, like everything that happened at that time. Considering everything that happened, they recovered by their next stock split. And ever since then, including the crash that happened in 2008, the correction that happened in 14, 15, 18, including the correction that happened at the beginning of 2020 with the pandemic and COVID-19, all of that stuff considered, they've still steadily rised, I don't know what that word is, and they're currently, as it stands, $128 a share. So this is actually one of the best performing stocks that we've looked at thus far, because if you take away the market corrections that happened, because it hit everybody, these corrections, these dips that we see in this graph right here, it applied to every company that we've looked at so far. There hasn't been a single company that was not affected by these different crashes, but this is the first company that has steadily recovered and then beat their previous heights prior to that crash. If you look at every single crash, their new height has always been higher after the crash. Now, it's really interesting when you look at this, because all of these brands that we listed, these aren't luxury brands. These are everyday household items that people use. So when you look at a company or a stock to purchase, it's really interesting to look at, because you obviously have like the technology stocks and all these different things that have this potential of blowing up and doing a lot of great returns for you. But then there's these solid companies that have been around for a really long time. They have a really strong foundation because what they sell is something that people just need. They use it all the time. You use toothpaste and soap all the freaking time. Hopefully, right? You use toilet papers and you use paper towels all the time. And this is the kind of stuff that is, I feel like, forever green, right? And so this is one of those unique categories, because so far we've pretty much looked at companies that have been very centered around tech, and then with the exception of Disney that we looked at, that's kind of around entertainment. This is the first company that we've looked at that's been in household consumer products. And then when you look at the actual performance of the stock, then you actually see, okay, you know what, this is kind of cool. These guys are always in demand. No matter what happens with the market, people are always buying and using their products. So it's a very, very interesting factor to consider when you're considering purchasing the stock of a company. Now, again, I say this in every episode, I'm not a licensed advisor. I'm a personal investor, and I'm fascinated by this. I'm in financial services, but I'm on the insurance side. So I'm not a securities advisor. I'm not a securities broker. So I do recommend that you speak with a securities or a stockbroker that's actually licensed to do individual sales, so on and so forth. Or if you're not going to do that, at the very least, please study before you make any kind of purchase or acquisition so that you know what you're getting yourself into. Because if you buy right here, and then the dip happens, then you're going to suffer a loss, obviously, in the value of your portfolio if you sell down here. But if you would have just wait, and then obviously it'll just return and come back. So it depends on how well you recognize these patterns, how well you understand the markets. So do your homework, please. Don't just jump into something without doing your due diligence. But it is something to consider. It is a pretty strong company to consider thus far based on everything that we've looked at. So now, let's look at their market cap, which is also a very, very interesting concept. And again, compared to every other company that we've looked at thus far, this graph is the most volatile, and it's actually probably one of the strongest ones to start with, right? 137 billion. Actually, I think this is literally the strongest or the biggest market cap that we, oh no, you know what? Who was it? I think it was Microsoft that was at 240 billion. But 2005, these guys are 135 billion. So this is the second largest company that we're looking at. 135 billion. By 2006, they were at 200 billion. That's insane. That's a really large gain. It's very, very interesting when you consider, if you go look at what happened with Microsoft and every other company that we've looked at thus far, it has never been a spike that happened in market gains like this or in market value like this. Then you have these dips. These are very interesting dips. And of course, this happened in around the market crash in 2008. So this one's very understandable. They also had another one in 2014-15. So these things we actually can compare to the actual performance of the market, but their value, the company value, this is what's representing the value of the company. So I'm actually very curious, and I haven't done the research on this particular part, but I'm very curious if this dip happened because they bought another brand or they went and bought more or reinvested into different things, if we're not considering market crashes, or if it literally was just because of market crashes or competitors that this took place. But even if that is the case, still, this concept, and I feel like this series as a whole, I don't think this series really applies to day traders, because day traders look at a lot of different variables when they're making their purchases. And as far as I know, stock splits aren't one of the biggest variables or one of the biggest things that they consider when they go into purchasing stocks and things like that. But when you look at the purchasing of a company to hold the stock, if you were to just buy it in 91, let's say, and I don't know how old you are when you're watching this, you may not have been born in 91. Well, let's say you were born in 91, right? Or let's say even if it's now, because like you look at, again, the historical performance of this company, and I look at it every 10 years, and every 10 years where it ends is higher than it was before. So when you look at a company like this, then that means that likely they're going to be around in another 10 years and another 10 years after that. Now, I can't speak for every company, right? Because we have Toys R Us that went bankrupt and Blockbuster and all these different companies that completely went belly up because of the tech revolution. But there are certain companies that were not affected by it, Procter Gamble really being one of them. So if you're buying to hold, if you're buying for a long-term position, then this is one of the strongest companies. Again, this is just an opinion, right? Please do your due diligence, go do your research, go speak with licensed advisors. I can't stress that enough. But if we're just doing 2 + 2 = 4, and if we're looking at certain criteria that companies should meet, strong company, strong net worth, strong market cap, performance has been pretty strong. They've always recovered after a crash has taken place. And it's a brand that everybody recognizes. Like, you recognize these products because they're all household products, and they're going to probably be around for another 20, 30, 40, 50 years. So this isn't something that's going to go anywhere anytime soon. So take it with a grain of salt, go do your own due diligence, do your own studying, do your homework, all that jazz. But this was another company that we looked at. So Procter & Gamble, very interesting company. And this was stock split. So I'm very interested to hear your comments. I want to see what your questions are around this topic. And we'll try to address them in the comment section below, or we'll just create videos around it to respond to your questions. But other than that, I hope you just found value out of it. And I hope that this is kind of like an insightful series that we're putting together for you guys. And yeah, I will see you in the next episode. My name is Arman Vakili, and this was the Stock Split Show. Talk to you guys soon.